could be here at 55.50. Get one position short, two positions short there. Next one, this is an open in GDRX, a technology sector health information services. Boy, just nicely done on this one. I just want you to notice the resilience that Ken H is displaying here. In the past month or 6 weeks, you've seen where he's been able to just keep piling on when the market was very favorable. And like when the market was doing this, he was crushing it with big multiples. But now that it's getting choppy, he's still in there firing, and he's taking the signals that he should take. Like, this is one you should take. And then that's the one you should exit, because you don't know that it's not going to come all the way back down. Then, as he notes, that was a potential reentry because you have a low, a higher low, and the perfect kata 2 is right there. But he waits for the Z3 pinch to resolve and gets this one, and with his stop here, and now raising that to no lose plus dinner for 2. I like that. I would probably raise that up into here and get paid a little bit, because if this rolls over, you want to capture as much of that as you can. But if it can get above this cluster right here at 44.50, that's where I think your next position could be, and your target is 47.50, and you can get third position going up there. So I like that one. That's in great shape. Resiliency. What I am really admiring in Ken's trading is the I talked about this in the systems thing today. He is a combination of careful and care less. He is careless in the sense that he has his chips in his chip stack, and he keeps making the antes. If that doesn't work, he takes the next one. So he keeps firing because he has a chip stack, and he's trading at a level, if those are all the chips in his chip stack, he's managing his chips, and he's playing it at a level that he can afford to play routinely, professionally for 1,000 trades. And that doesn't work. He just fires the next one because the trade frame is there. And in that sense, you will notice also that he is very careful, that he doesn't let this thing get worse. Now, you don't know that it's going to bottom out like this and resume. You have no way of knowing that. And in fact, if you were to look at this price right here, that's this price level. And there's every reason to believe this thing could have come back to 35. And that's another minus $5. And that's a 12% loss that he is protecting against. And that could very easily have happened. Look how fast it went up 5% 3 times, and how fast it went down this time. So as this starts failing right here, you absolutely take that shot, and then you exit it. You can consider this one, but Friday was so bad that I don't mind him waiting to see it get above the Z3 pinch to go. And I would actually raise this up into here now, I think, and be ready. And that's where that's where I would add. If once it gets above this, it wants to go. So he is a combination of careful and careless in the way that he is managing. He's managing that yin yang space beautifully right inside, inside that circle. He's doing a wonderful job of that, of balancing the need to be in the market and taking the shot, and at the same time treating those carefully in order to be precise and professional. But you got to keep taking that shot. So keep it up. Keep up the good work there. Let me cover briefly some important charts from earlier today with the THARP folks. So what they did was take a look at 5 out of the 6 market types that Van recognizes: bull, sideways, and bear. And they focused on the bull and the sideways. And so they took a look at, let's see if I can get this working. So if we were to draw this in the way we normally do it, bull, sideways, and bear, and then volatile, normal, and quiet, they took a look at 1, 2, 3, 4, 5, and 6. They took a look at those 6 market types in that workshop, and then got into small groups, and then each group designed one system to trade. And then they did assumptions, filters, setups, market condition, entry rules, management rules, the whole standard framing package, and then did some back testing and collected some R multiples, and then learned what they could learn from the research. And they did a nice job of that. And so this was the comments that I made generically about their about their bullish. Let's see, this one was bullish normal. And I made points about market classification models that you've got to re-justify the specific classification model you're using after you've gone through the details. Because you set up a set of hypotheses about the market in order to help you exploit the edge that you want compared to just naive buy and hold, right? So what you got to do is go back and see, did the market classification that I put together have value add to the rule set in order to keep it in the system? Or is there something I can do to adjust the market classification to make it more useful? They did some work in that one on putting symbols into volume and volatility bins to see if the different bins might have different performance characteristics on the signals. And that's a pretty good idea. I taught them about the idea of the trade index analysis to help discover if their initial intuition was putting them in the neighborhood of a good idea, even if that set of rules didn't do it. And that's something that I cover in the hybrid workshop. And the idea is something like this, that you think you have an edge. And so you put together a prototype system and find standard templates of trades, and then you run it through multiple case studies, and then you collect all that data. And what you want to check for is how efficient are you and effective at capturing the moves. What kind of trade management can you do, and is it suitable to be a production system? Well, here's how you do that in the trade index analysis. It's covered in the hybrid workshop. But I just want to briefly give you the idea. So you take each trade and you say at time 0 is when you entered, right? And this is where you entered at the 0 line. That's where the entry occurred. And then you have something like a -1R capital preservation stop. And then this is where you exit. You made a decision to exit. So you called the time from the entry to the exit time T. So then what you do is for each one of your trades, you go out to the 2T time frame, and then you find the maximum favorable excursion and the maximum adverse excursion. What was the worst price in the 2T time frame, and what was the best price, maximum favorable excursion, in the 2T time frame? And what you'll discover is when you do that to all the trades of a system, you can find out on average Are you seeing the maximum favorable excursions before you exit? In other words, price goes up and then it's over the hill and then you exit. And that would be the maximum favorable excursion. Like if you're always seeing them in region 1 here before you get to your exit, then what you can say is how much am I giving back? Because when I exit, it's not immediately turning around and going higher. But if it turned out that you were seeing a lot of those maximum favorable excursions here after you had exited, then that tells you maybe you need to relax your exit criteria and get a wider stop so you can stay in the trade, or you must have a re-entry criteria so that if this thing exits and then it starts to reverse, that you can re-enter. So by plotting the maximum favorable excursion and its location for a large data set using common rules, you can determine how suitable or how well tuned your timing of entries and exits are. By the same token, you want to find the maximum adverse excursion and determine if those things are happening here before your exit or after the exit. If the maximum adverse excursion is happening before your exit, then for some reason you got to wonder, how is it that I can enter and it came down here, but then I exited up here? It may be that your maximum adverse excursion is above 1R, and that would be good. Or maybe it's right on 1R. But you don't want to have that maximum adverse excursion being lower than you didn't take your exit. So you could find out if you had a problem in the way you were managing exits, right? But if the maximum adverse excursion is happening way out here after your exit, it may be that there is a stop and reverse if the distance to the maximum adverse excursion is far enough to justify that move as a win. Like your system might be positive expectancy and you're getting small gains, but then when it hits your exit, it's leading to massive reversals. You would like to know that. And so you have to do this trade index analysis as a way to understand the mapping of your price movement in the typical trades. We talked through with them the idea of where should they put their position sizing are. Should it be the average loss, the maximum adverse excursion? Should it be your average loss plus 1 SD? Or could it be, I briefed them on the idea of 5 times your execution risk so that you minimize the losses, but you use the idea of the MMRB. That idea absolutely blew their mind. And there's probably a dozen of them that are going to take the systems thinking or systems design course I'm going to teach in January just to learn that idea, which, by the way, is taught in the foundations course. So that is so important. And it really triggered them. The other ideas is defining the space or describing the space between the maximum favorable excursion and the maximum adverse excursion. If that was the best and that was the worst price, what is the shape of the histogram of price? Is it most of the time does it look like a standard deviation on its side with usually prices clustered in the middle? Or is it really weighted towards one side that you're seeing a real price anomaly? That will help you as you decide what kind of exit strategy is really suited for your kind of management. I took them through a brief discussion of what we treat as normal, and that is using the Bollinger Bands to form regions in which we can deploy the sniper and the manager exit. That was a new idea to them. And I said, look, anytime you've got an MMRB entry down here and you've carefully defined your risk, we think your idea is you should get to no lose plus dinner for 2 so that you lock in these gains. And as soon as you lock in the gains, the psychology of exits will tell you that you can treat this now as a managing a science project. Then in the life cycle of the trade as it's going up, you need to know the difference between normal behavior and abnormal behavior so that you know when you have moved into abnormal gains. And now how you decide to do the sniper or the manager is excellent, like PSAR for the sniper and Bollinger Band mean for the manager, or maybe it's a 1, 2, 3 if we had a really exaggerated gain. And then we blew their mind when we said, hey, you don't even have to think too hard about that. Just once you get past the abnormal boundary into abnormal gains, just give half to the sniper and half to the manager and split the difference. And then you'll spend all your time managing the sniper properly instead of suffering about which one should you use. That was a very powerful idea. And then they did a nice job of applying our approach to histograms to study the statistics of their trades, and they've adopted that as their standard assessment. So that was helpful. The next guys that talked were in the sideways quiet channel, and everybody hated sideways quiet channel. And I told them, well, I love the sideways quiet channel. And they said, what? I said, yeah. And here's why. The sideways quiet channel is critical state trading at its finest. And remember, we define the critical state as a higher probability of a larger than normal move in a shorter than normal period of time in either direction in order to gain a realistic profit target in both directions against the MMRB, or the manageable risk. So in the perfect world, what you have is price that ends up in a local doji. The last bar is a doji. And a doji is defined as an abnormally small endpoint. And you want that to be in a string of bars that themselves are getting smaller and sideways. So what you want to see then is something like 10 to 30 bars where the Bollinger Band mean, or the 30-period simple moving average, is basically flat-ish, and the Z3 lines are pinching to show that the trend is becoming abnormally small. And then if you can put a frog box around that intraday, or a 1 ATR, 2 ATR box on a daily chart, and then the last symbol is a doji, and it's right on the Bollinger Band mean, perfect, then you can decide what price will get you in. Is it as soon as the doji is broken, or do you wait for the Z3 line, or someplace in between? And are you going to take a risk here or here? So wherever you decide to draw the risk box, the smaller the better. And now you take a minimum manageable risk box. And then if it breaks out and you get long here, your job is to get this to no lose plus dinner for two as soon as possible in order to lock in the gains. And when you do, psychologically, all you're doing is managing a science project, and you will be in a state of calm because you have no anxiety left over and you are in the zero state. So you can manage just like a little scientist. That's what we mean by the phrase risk-free rate of return. So you're just wondering, how much will the market give you consistent with your exit strategies? And then I talked them through how to set up the indicators that might do this. And I said, this thing is fractal. You'll see sideways quiet channel, a critical state trading every single day in the market in dozens of symbols on 1 minute charts. And if you know how to trade that, you will love this, because you can now go in either direction as soon as the breakout occurs. So I'm not afraid of that trade. I love that trade. And the tighter it pinches and the smaller the doji, the better I like it, because my MMRB is smaller and I can get to a science project very fast. That blew their mind. They thought, because all they were thinking about was swing trading on daily charts, and didn't realize that all of this stuff is fractal. So they got a lot to learn. It's going to be fun. This next chart was then to show them the idea that they each had designed a different system for a different market class, and they were using different definitions of market classification. I said, that's fine so far, but what you really want to get to is have standard work for indicators in your dashboards, which are fractal, so that you have a standard way of making typical decisions, and it's very robust across many time frames and in all market conditions. And then you can build the standard work for normal conditions, and then you can build standard work for abnormal conditions. And if the 4 phases are plan, prepare, execute, and assess, you especially want to make sure that you have standard work for assessment, which means that you're collecting data from a standard system rule set, all using the same rules, that you can actually compare apples to apples. And I said, once you do that, you can now make sure that you understand the transitions between these different market states. Like, it wouldn't surprise me to see something start off in sideways quiet, and then that thing is oscillating back and forth until it starts shaping upwards slightly, and it becomes bullish quiet until people notice that that thing is no longer sideways, but in fact it's moving upward. And then more money comes in, and now you start getting bullish normal, and you're managing your stops. And then you may get this explosive culminating move. And so you want to make sure your stop gets in to capture most of that. So now, in a comprehensive approach to the markets, you want to have standard definitions and indicators and dashboards that are fractal, so that the same dashboard can help you regardless of which mood you're in. You don't have to completely stop and reconfigure your screen for a brand new, different kind of trading. So that's painful. That's a lot of work. So we want standard work up in here. Another cleaner way to look at that is, I might have in a sideways market, what remains constant is the fact that price is going sideways. It's not moving up and down. It's always coming back. So in a quiet, those little waves and bounces are small. That's why I love the sideways quiet channel, because I can play the breakout in either direction. And then sideways normal, it's still going sideways on average, but now the amplitude is bigger. That one's actually harder to trade than quiet, because you don't know, should I be trading the breakout or should I be fading it? And there's not as much room on the breakout, because the breakout has already, you missed that early move. And then the reversion to the mean is harder, because the distance is not so great. It's not until you get into sideways volatile that you can wait to see this move, and now it fails. And now I can play the reversion to the mean, and I got 1, 2, 3. I have 1, 2, 3, 4 units of reward against the 1 unit of risk after it has risen and then reversed. And so I'd love to be entering here, cashing here, and stop and reversing, coming back. Now I can play both angles. And then if it goes further, I get maybe 5, 6, 7, 8. So I love sideways volatile, because I don't have any belief that it's going to keep going, but I'm just waiting to take my exit when it rolls over. And then eventually that sideways move could morph into a bullish move if the preponderance of the winners are moving long, or it could revert to a bearish move if that thing tips over and starts failing. And then in point of fact, what I really want, the markets that I love to trade are the abnormal ones, and not so much the normal ones. I would much rather have sideways quiet or sideways volatile. I'd love those, because The breakout move can be big, and then the reversion to the mean can be big. What's hard for me is sideways normal, where it's chunking around and there's lots of false breakouts, and then the move back to the Bollinger Band mean is not good enough. And then I like bullish quiet and bullish volatile. Again, I can play the breakout, and hopefully that thing grows and becomes a parabolic move, and then I can capture and maybe play reversion to the mean inside of the bull. And then I can play kata twos all day long. And then I like bearish quiet and bearish volatile because I love the collapsing dragon. I love bearish normal too, because collapsing dragon is my favorite play. The one that's hard is sideways normal, bearish normal, or a bullish normal, I should say, and bearish normal. The other things that I talked to them about was I posted this in Patreon, and I want to just talk through this real quick. This came out of the morning True Story Circle that we did. And the idea is, I don't know if you've ever had this feeling, but I want to show you that when you change one word, you're actually changing one world. You change one word in the story, and the entire story is changing, and a whole new world is open. Look what happens when I just add the letter L, and I change that one word. Change one word, change one world. A single letter is amazing. So listen to how this feels. Sadly, I feel like I am just a grain of sand on an infinite beach. Sad, despair. Now I make a decision to reframe. I'm going to take that energy and I'm going to just give it to the universe and say, this is genuinely how I feel. I'm going to tell you the honest truth out loud. I'm going to name it and tell a story and bundle all of that emotion into the story, and I'm going to offer it to the universe, which is large enough to take it. And the universe wants to hear those true stories. And then what I'm going to do is just set the word just aside, and I'm going to say, I am a grain of sand on an infinite beach. Listen to the difference that one word makes. Sadly, I feel like I am just a grain of sand on an infinite beach. Sad. Compared to, I am a grain of sand on an infinite beach. And here's why that makes a difference. I'm going to just read the text to you because I like the way it sounded in my ear.